everyone. This is Dr. Supreet from Department of Commerce, Delhi School of Economics, University of Delhi. Today we'll be talking about Introduction to Income Tax. So now we are going to talk about the different regime structure. Now the government has inserted a new section, that is this section 115 BAC, which actually provides for an alternative tax regime structure under your section this 115 BAC. So usually we have right now presently we are dealing with two sorts of our regime structure, that is the old tax regime structure and the second one is your alternate tax regime structure. So before moving on to different detailed you could say the slab rates for these alternative and the old tax regime structure, we'll be having a little discussion about what this alternative regime structure is for. So this alternative tax regime structure is provided for individuals and HUF, and it altogether provides us with a new tax slab wherein the tax rates have been significantly reduced by the government. Now, under this Finance Act 2020, government has come up with this, new section 115 BAC, whereby it is proposed that in order to, provide the more benefits to the citizens, this alternative tax regime structure will be proposed. But in order to avail the benefits under this alternative tax regime structure, the SSC has actually to forego various exemptions and deductions. For example, there are numerous deduction and exemptions that we claim otherwise, but once we opt for this alternative tax regime structure, we have to forego all these deductions and exemptions. For example, all your deduction which are there available under your section 80 TTA, TTB, your LTC, HRA, any minor child income allowance, children education allowances, your chapter 6A deduction that we discussed upon, that is your 80C to 80U, but it excludes certain categories. For example, 80CCD2, you can avail the benefit under the same, right? So similarly, any contribution to NPS, employees own contribution, any donation made to any political party, any interest on housing loan of any self-occupied property or the vacant property that we do in section 24. So in case a person is opting for the alternative tax regime structure, it has to forego these exemptions or the deductions. Now we do have this two segmentations for the individuals under the old tax regime structure and the new tax regime structures. Now we do have a comparison of the same. Under the old tax regime structure, your income for the individuals below 60 years of income, we have the income exempted up to rupees 2,50,000. That means all the individuals who are below 60 years of age, their income up to rupees 2,50,000 will be exempted. And then we have different slabs that more than, if in case you are having an income more than your 2,50,000 but less than 5 lakh rupees, in that scenario you are supposed to pay the taxes at the rate of your 5%, not onto the entire amount of your 5 lakh rupees but onto the amount that exceeds 2,50,000. For example, you are having a net income of your, let's say, 3,50,000. In that case, your income up till 2,50,000 is exempted and you are only supposed to pay the taxes on that excess income of rupees 1 lakh rupees at the rate 5%. Similarly, under the alternative tax regime structures, we are having different slab rates. We are having 7 tax brackets wherein the rates, they are varies from 5% to 10%, 15%, 20%. So these rate tax structures, they vary. So these are the two tax structures that have been proposed by the government under the old tax regime structure and the new tax regime structure. Similarly, the rates are there for your individuals who are more than 60 years of age, but they are not super seniors. So government has made it very clear that all those people who are more than 80 years of age, they will be classified as super senior citizens, and they will be getting an exemption benefit of rupees 5 lakh rupees tak. So up till your 5 lakh rupees net income, you will be getting a benefit of your income tax if case you are a super senior citizen under your old tax regime structure. Similarly, for your senior citizens, that means who are more than 60 years of age but less than 80 years of age, the exempted amount is rupees your 3 lakh rupees. Similarly, the corresponding alternative tax regime structures have been given. Next is, we do have the surcharge onto income tax, and this surcharge remains the same whether you opt for the alternative tax regime structure or you opt for the old tax regime structure. So we do have these surcharge rates which are applicable. For example, you are having an income of more than 50 lakh but less than 1 crore. So then in that case, the respective amount of your surcharge would be levied onto your amount of income tax. Now moving on to further about the different residential status and what impact or the effect does it have on your tax incidence. Since we are talking about, we do have different categories of individuals wherein we are classifying them as those who are less than 60 years of age, those who are having being a senior citizen who is having a more than 60 years of age but less than 80 years of age, and then comes a category of your super senior citizen. But what does it matter? How does it matter ki you are supposed to pay these much taxes or the other rate of taxes will be applied onto you? That depends entirely on your residential status. So we have different taxable entities. We have individuals, we have Hindu undivided family, we have firms, we have association of persons and company. So we'll be talking about how the residential status differ in all these categories and what all are the conditions applicable in all these different categories of persons and the entities. So coming on to the first very category of your individual. So in order to assess that whether an assessee is a resident or a non-resident, we have different classifications. Right. So under we actually have two major classifications, that is either a person will be a resident in India or he'll be what? He'll be non-resident in India. And for this resident in India, we are having further two classifications, that is resident and ordinarily resident in India, which we classify as ROR, and the second one is your resident but not ordinarily resident in India, which is your RNOR. Right. So for all these things, we are going to further see in what all cases this resident, the person would be resident, or the person would be an ordinarily resident, or he'll be a not ordinarily resident person, and the different cases where he'll be also considered as a non-resident. So the first very case that we are going to take up under section 6 for determining the residential status of an individual. So for that, for an individual, there are actually two set of conditions, one being the basic conditions and the second set of conditions are your advanced conditions. Now talking about the basic conditions. So basic conditions we have two sorts of conditions. Number one is that this particular person for which the residential status is being assessed, if in the previous year he is in India for a period of more than 182 days. For example, we are talking about this previous year 2022-23, which runs from 1st of April 2022 to 31st of March 2023. So for example, if that particular person is in India in the previous year, in this particular previous year, for a period of 182 days or more, then we say that this person, Mr. X, he is satisfying the very basic condition, because in this basic condition we have two choices, right? Either we satisfy the condition number 1, which is that the person is in India in the previous year for a period of 182 days or more, or we satisfy the second condition, which is that the person is in India for a period of 60 days or more. So here the period curtailed down to your 60 days period, and we says that though in the previous year he is in India for a period of 60 days or more, but there is an additional condition that is attached to this, very basic condition that says that in the relevant previous year he has to be in India for a period of 60 days, and that means additionally he is supposed to have stayed in India for a period of 365 days or more during the 4 years immediately preceding the relevant previous year. Now the relevant previous year in this scenario is your year 2022 to 2023, and the 4 years which would precede this relevant year would be your 2021-22, 2020-21, 2019 to 20, 2018 to 19. That means in totality in all these 4 previous years, the person should have stayed in India for a period of 365 days and more, and plus he should be in India for a period of 60 days or more during the relevant previous year. So that means either the person satisfy the basic condition number 1 or the basic condition number 2. If he satisfy any of these conditions, any of these 2 conditions, then we would classify that individual as a resident in India, right? So this classifies whether a person is a resident or a non-resident. Now to further move on to this segmentation, that whether this person is a ROR or a RNOR, that means a person who is resident and ordinarily resident in India, or a person is a resident but not a ordinarily resident in India. Because all these different residential status, they have an impact on the incidence of taxes. Their liabilities would be accordingly being you could say assessed. So there, apart from those basic conditions of which the person is supposed to only meet the one condition only, in order to further, let's say that the person, let's say whether to check he is an ROR or he is RNOR, will be checking upon 2 additional conditions. The number 1 being he has been resident in India in at least 2 out of 10 previous years immediately preceding the relevant previous year. That means you are not going to consider the relevant previous years, but 10 previous years which precede this particular relevant previous year. That means out of previous 10 previous years, you are supposed to be resident in India for at least 2 years, right? So in case you are a resident in India and you have been for, let's say, 2 previous years out of the 10 previous years which immediately precedes your relevant previous year, then we are saying that you are meeting the additional condition number 1. Now this is your additional condition number 1, along with you are also supposed to satisfy the additional condition number 2. That is why the word used here is and instead of using it as an or. So it says that the person, he has been in India for a period of, let's say, 730 days or more during the 7 years which immediately precede the relevant previous year. So that means you are supposed to stay in India for a period of 730 days or more during the 7 years that immediately precede the relevant previous years. So in case when the person is meeting, let's say, any of the basic conditions plus additional these 2 conditions, then only he will be considered as ROR, otherwise the person will be considered as RNOR. Now there is one important exceptional rule that is there applicable in case of your basic condition, because in the basic condition we have talked about that a person who is in India for a period of 60 days. So we do have that choice, but there are certain category for whom this choice of 60 days is not available. That means they have to look for that period of 182 days only. Now what all are these cases are? Let's say for example any Indian citizen who is leaving India for, let's say, a purpose of employment outside India. So in those cases any Indian citizen who is living India for the purpose of employment outside there in India, then we says that he is supposed to meet that basic condition number 1 only, that benefit of meeting either of the two condition is not available, that means he is supposed to be in India for a period of 182 days in order to be a resident in India. Similarly, any Indian citizen who leaves India as a, let's say, a member or part of being any crew of Indian ship, in those scenarios also this benefit of 60 days wala condition would not be available. He is supposed to satisfy that condition of 182 days. Then the last category comes out when any Indian citizen or let's say a person of Indian origin. We call a person as a person of Indian origin only when his grandparents, being both the paternal or the maternal one, if they were born in undivided India, we say them as a person of Indian origin. So that particular person who is of Indian origin or an Indian citizen, and let's say he comes on a visit to India during the relevant previous year, in those scenarios this benefit of 60 days condition is not available. He is supposed to meet the that 182 days condition only, right? So he is not having that option number B in order to satisfy for the basic conditions. So this is about your residential status of an individual. Next we'll be talking about the residential status in case of your Hindu undivided family. So in case when we are talking about Hindu undivided family, we actually go for the control and the management of affairs. By control and management of affairs, we mean, let's suppose that Hindu undivided family is having the entire set of his operations, his control, his management of all the operations there in India. The entire set of being, control being there in India only, then we would say that this Hindu undivided family is resident in India. But let's say it is having a partly control in India or let's say a partly control outside India. In those scenarios also we will be classifying that Hindu undivided family being a resident in India. But in case the control and management of affairs is wholly outside India, then we will be saying that this particular Hindu undivided family is a non-resident in India. Now, similar to your individual, Hindu undivided family also enjoys the benefit of the status of ROR and RNOR. Now, this benefit is available through the the residential status of Karta only. So, whatever be the, if the Karta is meeting those additional conditions which we talked about, for example, those additional conditions were for that this Karta has been resident in India, let's say in at least 2 out of 10 previous year, immediately preceding the relevant previous year, and that means additionally the Karta is also supposed to be in India for a period of 730 days or more during 7 years immediately preceding the relevant previous year. So, if the Karta is meeting both these conditions, then we would say that yes, this Hindu undivided family is not just a resident, but it is a resident and ordinarily resident in India. And in case the Karta does not meet these two additional conditions, then we will be classify them as that Hindu undivided family is resident but not ordinarily resident in India. Now moving on to residential status in case of your firms and association of persons. So in case of your firms and association of person, we look for the place of control as we see it in the case of your HUF. So here also we will be talking about the control and management of affairs. So similarly for firms and associations of persons, if the control and the management of affair is there wholly in India, we will be classifying them that this particular firm and association of person is resident in India. And if it is wholly outside India, we will be saying that the entire set of your control and management of affairs, it is outside India. So in those scenarios, this particular firm or association of person will be non-resident in India. But let's say the control is partly in India and partly from outside India, then also this firm or this association of person will be classified as being resident in India, right? Now moving on to the next segment, which is with respect to the residential status in case of your company. Now, whenever we talk about companies, we have two segregations. We have Indian company and we have foreign company, right? So, when we talk about Indian company no matter what will always be resident in India. Any Indian company, let's say when we talk about this Indian company, we talk about domestic companies, any companies having substantial interest, which are the publics are substantially interested in those companies. So all these Indian companies, they are irrespective of any fact, they are always resident in India. Now, the second category comes into the picture is your foreign company. Now, foreign company we do have two set of classifications, whether the company would be seen up on the basis of your turnover, that what all are the turnover or the gross assets of the company, and onto the basis of the same, the residential status of a company will be determined. For example, any foreign company whose turnover is less than, you could say, 50 crores or let's say equals the 50 crores, then will be directly saying up that this particular foreign company is non-resident. So you would see that in case of Indian company, we are not making any segregation on the basis of turnover, but in case we talk about the foreign companies, we are talking about the turnover limits, because foreign companies do not enjoy the benefit of being resident in India, right? Like anyways, they have to go through, there are certain limits, there are certain turnover limits which we have to go through, which we have to see in order to check whether they are the resident in India or they are non-resident in India. So as we mentioned, in case the turnover is 50 crores or in case it is less than 50 crores, then we'll be saying that this particular foreign company is a non-resident in India, right? Apart from this, if we say, let's suppose the company is having a turnover of more than 50 crores, in those scenarios, we'll be talking about that, we'll be checking about the place of effective management, that we call it as POM. That means we'll be looking upon, in case the company is having the turnover of more than 50 crores, we'll be seeing that its place of effective management, it is there in India or not. So in case during the relevant previous year, the company is having more than turnover of more than 50 crores, we will be looking for the place of effective management, and in case that place of effective management is in India, then we will be saying that yes, this foreign company is resident in India. So here you could see that how the residential status of different entities, they differ, right? In case of our individual, we are looking upon whether the individual is resident, he is non-resident, and in case of resident, whether the individual is resident but ordinarily resident and resident but not ordinarily resident. Similarly, in case of your Hindu undivided family, we are looking upon whether that Hindu undivided family is having the control and management of affairs in India, or let's say partly in India and partly outside India, then we'll be classifying them as the resident in India, right? And in case the entire set of control is outside India, we'll be classifying them as non-resident. So in case of your HUF, because of this karta, the benefit that karta enjoys, it is also having that benefit of being a ROR or RNOR that we discussed upon, right? But in case of your firms, an association of person will be only looking upon the control and the management of affairs. Similarly, in case of your company, we'll be looking upon whether the company is an Indian company or a company is in a foreign company. So if it is a foreign company, we'll be similarly making a look onto the turnover of the company. So if the turnover or the gross receipts that we call upon, they are more than 50 crores, then we'll be also looking upon that its place of effective management, that is the POM. So what will be its place of effective management? So if place of effective management is in India, we'll be calling them as the resident in India. So that is all about the residential status of different taxable entities, which includes the individuals HUF, Firm Association of Persons and Company. Thank you.